Very good morning, folks. At the outset, let me welcome each and every one of you for the Fast Track webinar series for CA Intermediate Paper 3, Cost and Management Accounting. This is first of its kind, especially with respect to Cost and Management Accounting, focusing exclusively for exam purpose for November 2020. Every date from today, exception 1 or 2 days, which I'll be mentioning in my day class when you have to log in, because in between we'll have some holidays also. Nevertheless, every day morning 8:30 a.m. we are going to meet for the next 7 days. It's going to be a fast track session. So therefore, I'll only be focusing on exam oriented topics as well as the chapters. And let me now screen share so that I'll tell you what is the topic I'll be discussing today. Once again, guys, welcome back and welcome once again for the Fast Track webinar series for CA Intermediate Paper 3 Cost and Management Accounting. Today we are going to see Paper 3 Chapter 13 Standard Costing. Now, before I enter into this particular topic, I'll just give a very small brief. Why? Because this particular chapter is not missed in examination. Every examination you at least get 5 marks or 10 marks. Now let me just share with you some of the questions. Please look here. May 2018, this is a 5-mark question. November 2018, this is a 5-mark question. May 2019, this is a 5-mark question. And November 2019, this is also a 5-mark question. So definitely you have a minimum of 5-mark question. Sometimes they also ask a 10-mark question. Okay. So I'll try to actually maximize our time. So I want you to actually focus very much attentively. And since this is in a YouTube, the entire video will be available in the channel, and every day to get the respective link enabled, okay, or notified to your system or to your mobile, ensure that you subscribe my channel. Number 1, remember this, subscribe my channel. Second, automatically once you subscribe, the link will be notified to you. And there is also an alternative. There is an all India CMA, very serious students alone are there in that particular group, no nonsense group, where you wish to be part of that particular group and knowledge group. Please send a SMS to my number. I'll share my number at the end of my session. Okay. So please send a request along with your name. I repeat, along with your name, your student registration number. Example, SRO, CRO, or WRO, or NRO, okay, or ERO. So send your student registration number. Name, student registration number, location, the city from where you are, and fourth, your mobile number to get yourself enrolled as part of that WhatsApp group. Very good, guys. Now I want to just share with you only simple thing. Okay, very simple thing. I wish whenever a question is asked in variance, all of you must get full marks. All of you must get full marks. How? That is what I'm going to share with you now. Remember, guys, standard is there in everyday's life. Everyday's life standard is there. And especially in life, what your mom will say, see what your friend has been getting marks, you are getting very low marks. Number 1. Number 2, people will compare you with father and aunt, uncle. So everywhere this comparison is there, and they'll come out with the negative part of it. No, you are not up to that particular mark. So variance. Standard is a particular comparable. A comparable is called a standard. Variance is your performance with that performance is the difference is variance. Now, in life, don't get dejected when people compare. In life, don't get dejected when people compare you with the standard performer, and they come out with a negative variance. Otherwise, we call it as an adverse variance. Please look at this. Okay, comparison. Okay, comparison. And when they tell you that you are not up to that mark, don't get dejected. In life, whenever people do variance analysis, learn. I repeat, learn from that. In business, whenever we do the variance analysis, now we are going to do, that is the place to understand and earn. Business is a place where you earn. Okay. Life is a place where you learn. Okay. Please understand this, guys. Very important. Standard costing is there in our life. It is there in our life by default. By default, it is there. So therefore, this is a chapter which has to be very, very simple for all of you. Very simple. And I'm going to take the most interesting area, that is, and which is also an exam oriented question. Let me now take you directly to this illustration 7, otherwise called the practical problem number 7 in your study material. In your study material, chapter number 13, okay, illustration 7 or practical problem number 7. Okay, this is a question I'm going to solve now. And a very similar question has been asked in November 2018. I repeat, a very similar question has been asked in November 2018. So this is a macro question, and I'll say this is a micro question. That's it. So once we understand this, we'll directly go into the other variances. Please try to catch what I am conveying to you. Okay, my way of explaining variance is very simple. Understand standard, understand actual. That's all. Always go for the difference. Let us see that quickly. Okay. So this is what I'm going to do, guys. Please look here. This is XYZ Limited. So your practical problem number 7. Okay. So I'm going to do the fixed overhead variance. We have a very, very limited time. I'm only going to do 1 hour, guys, so not more than that. So therefore, I need your complete attention. I repeat, I need your complete attention. Okay, good. So good. Now, please look here, guys. This fixed overhead variance. Okay, fixed overhead variance. Okay, I'll just divide this. Okay, I'll just divide this into, I'll say 2 parts. Okay, 2 parts. So maybe I'll just take it here. So 2 parts. So what is it? The expenditure variance. So I'll call it as a FOH, expenditure variance. I'll call this like this. So expenditure variance. So this is the first one. I'll explain this, how it has been coming. And similarly, this is what do you call it as the volume variance. I'll explain why it is called volume and all. And this volume will be further divided into, okay, so maybe I'll keep this here, this is further divided into, okay, 1, 2 and 3. So 1 is okay, I mean, I'll get it here, so 1, 2 and 3. Okay, that's good. So what is it? So 1 is called as fixed overhead, your efficiency variance, and the fixed overhead, the capacity variance, and the fixed overhead, the calendar variance. That's it. Very simple. Now, let me explain this. Only when I explain this part will be clear. Okay, so good. So this is your breakup of your variance. Good. Now, as I told you, I'm going to explain this in a very, very, I will say, in a practical sense. So let us first take this particular question now. The XYZ Limited is furnished to the following information for the month of August 2012. The budget is given, actual is given. Remember, guys, there is always a difference between budget, I'll put it here, budget and actual and standard. Okay, budget, actual and standard. Budget is always for a period. Actual is always, I need not explain what actual is. Okay, this is your performance. This is your performance. Standard is always per unit. Per unit. Per unit need not be per, what do you say, the unit need not be the production. Okay, need not be a production or in terms of the number of the commodities. The unit can be the commodity what you manufacture, hour, days, it can be anything. Per day cost, per unit cost, per hour cost, anything in per unit. That is called anything in per unit basis is standard. Okay, we always, because that is what the comparable. Good, now in this question, they are given units, guys. So this is budget and this is actual. So now I will explain this, then we are going into the question. First, let me explain this. So you have units, guys. Then you have the hours. Then you have the days. Then you have the fixed overhead. Okay, in rupees. Good. So what I am going to do now, okay, this is your budget and actual. Variable overhead, I will do it as a separate question. Okay. So what is your units? 30,000. What is your hours? 30,000. That is also hours is 30,000. What is your days? 25 days. It is actually per month. Maybe this is for the month of August. Okay. So please look at this. Details for the month of August 2012. So whatever it is. So this is what they have given, guys. Details for the month of August. Okay, that's good. So now let's see what is your budget and the actual, and what is your fixed overhead? 45,000. Now what is your actual, guys? Your actual number of units is 32,500. Your hours is what? 33,000. Number of days is how much? 26. That's, and what is your fixed overhead? 50,000. That's all. Henceforth, you need not go into the question at all. Henceforth, you need not go into the question. Let us directly jump into this. Now, as I told you, you need to first find standard per unit. So, remember, guys, from standard only you develop budget. Because standard is per unit, budget is per period. This is per period. Per period. Sometimes per month is also budget only. But we always bring to the lowest unit of measurement. Lowest unit of measurement is 1 unit, 1 day, 1 hour. Okay. So all those will be standard. And how do you fix a standard? That's a different, what do you say, chapter. You have a fixation of standard in your labor chapter. How do you fix a standard and all? Okay, there is a very nice person who has actually given a logic called as Professor Gilbert. Professor Gilbert has actually given the logic for devising a standard. I'll come to that a little later. Now, please look at this particular question. What is your fixed overhead? So, this is your first working note number 1. I'll call this as working note 1. Okay. So, maybe I'll cut this and I'll keep it here. So, all of you should understand that. So, this is your fixed overhead. So, working note number 1. What is working note number 1, guys? So, what is your standard fixed overhead, okay, per unit? Okay, standard fixed overhead per unit. What is your standard fixed overhead per hour? What is your standard fixed overhead per day? Standard fixed overhead per unit is how much? Okay, so maybe I'll just increase this. So standard fixed overhead per unit is how much? This is standard fixed overhead. This is fixed overhead budgeted. Budgeted is for a month of August. That budget you divide by the number of units. 30,000 units, 45,000 rupees. So 30,000, 45,000 divided by 30,000. It means 1.5 rupees per unit. This is per unit. Per unit. Fixed overhead per unit. So 30,000 units, 45,000. So don't go to actual. Analyze only budget. Remember, budget is for a period. Standard is for a unit. So if you want budget from standard, you multiply, you will get budget. If you want standard from budget, you divide, you will get standard. So what I am doing is only division. So what is fixed overhead per hour? How many hours in a month? In a month, it is 30,000 hours. For 30,000 hours, it is 45,000 rupees. So therefore, it is again 1.5 rupees per hour. Technically, what is your standard? I will call this as how many standard hours per unit. Per unit, how many hours? So, number of hours is 30,000. Number of units is 30,000. So, 30,000 hours divided by 30,000 units. Meaning, it is 1 hour per unit. 1 hour per unit. 1.5 rupees per unit. So, this is rupees per unit. This is rupees per hour. This is hours per unit. Please understand the difference, everything. Now, for 25 days, it is 45,000. So, it is 1,800 rupees per day. This is the first working all of us must do. This is the first working. And now remember, guys, fixed overhead variance is always with respect to compare the units. Compare with respect to units. Now, come to actual. Always you have to compare. Now, what is the target, guys? You have spent 33,000. This is your target. You have spent 33,000. I'm sorry. You have spent 33,000. Now, we are going to find whether 33,000 what you have spent is a favorable expenditure or an adverse expenditure. Now you are going to find variance. You are now going to compare. Okay. And you are going to like mother or father or uncle or aunt or your teacher. We are now going to compare and we are going to find the fault. And equally finding fault when you are saying, you should also appreciate. You should also appreciate. You should have that heart to appreciate. Okay. Now we are going to do that both. So life is actually debit and credit. Okay. True and false. Okay. Good and bad. Favorable and adverse. So how you take an adverse, you should also take the same thing favorable. Okay. 33,000 you have spent. 33,000 you have spent. Always remember fixed overhead variance. Okay. Working note number, I will call this as 2. How will you find fixed overhead variance? This is actually the total variance. Remember, guys, I am going to use only units. I am only going to use units. Now, units. How many units you have actually manufactured? Okay, output is 32,500. So for 32,500, you have spent 33,000. Remember, guys, actual units. Okay, this is actual units. Always any total variance, whether it is fixed overhead cost variance, okay, you can call this as fixed overhead cost variance or total fixed overhead variance, whatever name you give, it doesn't matter. This is total variance, okay. So I don't want to, this is fixed overhead variance. Fixed overhead variance, you will actually divide into various, you are going to analyze it. So analysis is next. So which is always with respect to actual units, whether it is fixed overhead variance, variable overhead variance, material cost variance, labor cost variance, okay, everything is only with respect to actual. Okay, so in actual units, now please look at this, guys. Actual units per unit is how much? 1.5 rupees. How many units actually you have manufactured? 32,500. Now for 32,500 units, you are going to find what is your actual fixed overhead, what is your standard fixed overhead. Otherwise, you can call it as recovered fixed overhead. Okay, but you cannot call it as a what do you call it as a budgeted fixed. Budget is always with respect to period. Budget is always with respect to a period. That is why we say in February 1st, 2020, annual budget was announced by central government. It is always for a period. So this is actual fixed overhead. You have to call this as recovered fixed overhead, or you can call it as a standard fixed overhead, okay, or absorbed fixed overhead, anything with respect to these units. With respect to these units. So now very simple, guys. What is our actual fixed overhead? 33,000. What is a recovered fixed overheads? Otherwise called as with respect to 32,500. So with respect to 32,500, per unit is 1.5. So 48,750. Okay, 48,750. Good. So, I'm sorry, where is it? I'm sorry, not 33 is not this. This is 50,000 rupees. 50,000. This is 50,000. So actual fixed overhead is 50,000, and your recovered fixed overhead is with respect to your actual unit. So 32,500 at the rate of 1.5 rupees. So 48,750. Now, guys, very simple. You have to take the difference between these two. Okay, you have to take the difference between these two. That's all. So now for 32,500, you should spend 48,750, but you have spent 50,000. So I'm not going to say whether it is favorable or adverse. I'm not going to say whether it is favorable or adverse. And all of you must type in the chat box. Type in the chat box whether it is favorable or adverse. As and when I proceed. Okay. So you type it. So whether the difference between these two. So what is it? 50,000 minus 48,750. So it is 1,250. You have spent more. Actually, you have spent more. So therefore, it is adverse. So therefore, it is adverse. Good. So 48,750 minus 50,000. This is your fixed overhead variance. Now, fixed overhead variance here, I will bring this one step down. This I will bring it one more step down. The fixed overhead variance is 1,250 adverse. Wow. So this is 1,250 adverse. Now, this we are going to divide into two parts. What is it? Expenditure variance and volume variance. But remember, guys, expenditure variance is with respect. Volume is always with respect to units. Volume is always with respect to units. Oh, there also you did units. Here also you did units. But here I will find the difference between budgeted units and actual units. And expenditure is straight away for the budgeted expenditure. What is actual expenditure? This is actually STR. I will call this STRAIGXT. Straight. STRAIGXT. Straight. Okay. So why it is called as straight, I will tell you. So working note number 2. Now working note number 3. I am going to do the expenditure variance. Fixed overhead expenditure. Now please understand one thing about fixed overhead, because the logic of fixed overhead is totally different compared to material, labor and variable. Because in variable overhead expenditure variance, the concept is different. In fixed overhead expenditure, concept is different. In fixed overhead, time is for August month what you should spend. For August month, what actually you have spent. So that is why I will call this as straight for the month of August. Okay. You actually put within bracket straight. This is actually straight. Within bracket STRAIG. Straight. RAIGST. Straight. Now what I am going to do, please look at this. What is the, so instead of calling this, I'll call it as August. Straight for August, what is your expenditure? Okay. So August. Okay. For August, you should spend 45,000 because you have budgeted 45. You have spent 50,000. So in the question paper itself, comparing both, you can give the answer. By looking at the question, look at the question. 45 and 50, that's all. Instead of spending 45,000 for month of August, you have spent 50. So extra 5,000 you have spent. Naturally, it is 5,000 adverse. Okay, so here you will call this as budgeted fixed overhead and actual fixed overhead. Here it is recovered fixed overhead for 32,500. Here budgeted fixed overhead for August. Budgeted fixed overhead for August is 45,000. Actual fixed overhead is 50,000. That's all. So the difference is what? 5,000. That is also adverse. Why? Excess 5,000 you have spent. Good. So here it is actually 5,000. Now since it is 5,000, you can directly say if this is 1,250 adverse and this is 5,000, what do you call it as adverse? Naturally, your volume variance will be 3,750 favorable. Okay, net 3,750 favorable. So like your balancing figure. So 3,750 favorable. So green. How you are going to find this? Volume means always units. Now please look at the volume here. Units. 30,000. You should actually manufacture 30,000 only for the month of August. Budget for the month of August 30,000. But actually how much you have manufactured? 3,200. Wow. You have manufactured more. You are efficient. Okay. You are actually efficiency is a different concept. Okay. In terms of units. In terms of marks. Now I will ask my two friends I am asking. Two students. What is your mark in CMA? 62 marks. What is your mark in CMA? 65. Oh, wow, very good. 65 is. So 3 marks favorable. Okay. Same here. So working note number 4. So what is your working note number 4 here, guys? Volume. Volume. Now here, volume means units. Now, units between budgeted units and actual units. So budgeted units and actual units. Straight away budgeted units and actual. So what is your budgeted units, guys? Okay, your budgeted units is 30,000. Your actual units is how much? 32,500. Wow. And what is your fixed overhead per unit? That also you know. Fixed overhead per unit is how much? 1.5 rupees. So 2,500 units excess you have manufactured. Per unit fixed overhead cost is 1.5 rupees. So therefore, 32,500 minus 30,000. So 2,500 into 1.5. 37,000, 3,750. This is actually favorable. Straight away. So directly difference. So here your volume variance is difference between units. Expenditure variance is difference between amount what you spend between budget and actual. Now this volume variance 3,750, I am going to find the difference with respect to. So what I will do, I will bring this close here. And this also I will bring this close. So now we have this 3 guys. So let us find what is this 3. Okay. So this fixed overhead capacity calendar. So I'm going to find out. So efficiency is always with respect to hours. Remember guys, units to hours. Units to hours. Okay, I just reduce this font. Units to hours. Now, what is your units? 30,000 units. For that, how many hours you must utilize? So, efficiency. Efficiency is for how many hours, how many units, how many hours you must take. How many hours actually you have taken. Okay. Capacity. Capacity is always with respect to your days. Calendar is only days. And remember, guys, capacity is days with respect to hours. Days with respect to hours. Efficiency is units with respect to hours. Capacity is days with respect to hours. Calendar is only days. Only days. This part alone you must understand. Fixed overhead variance means only units alone you take. Units, how many units you have actually, what is your cost per unit? What is your cost per unit? What is the actual amount you have spent? Expenditure variance, straight away budget and actual. Volume variance, straight to take the difference between units. But here, for the actual units, how many hours? What is actual hours? For the actual days, how many hours budgeted or your standard hours? What is your actual hours? And what is your days? So let me do one by one. So your working note number 5. Okay. Straight away, let me do calendar variance first. Calendar variance means the days, difference in days. So what is your budgeted days? What is your actual days? And what is your fixed overhead per day? That's all. Simple. What is your budgeted days, guys? Budgeted days is actually 25 days. But you have worked 26 days. You must only see the days. You must only see the days. And what is your fixed overhead per day? Fixed overhead per day 1800. Now, don't see the volume, and all. That volume I am going to see separately. That is capacity, that is efficiency. See only the days. Because fixed cost is your rent is fixed, salary fixed. All these are expenditure. For the fixed salary, fixed rent, fixed expenditure, you should actually work only 25 days. But the actual is 26 days. So for that expenditure, you are able to generate one more day, one more working day extra. But with that one more working day, have you worked? Are you efficient? Have you produced? All this we will see separately. So technically, one day extra. One day is 1800. So therefore, 26 days minus 25 days into 1800. So there is 1800 favorable. 1800 favorable. Okay, that's all. So this is with respect to 1800 favorable. 1800 favorable. So green color. Now let us see the capacity. I told you capacity means hours, but with respect to days. Efficiency means hours, but with respect to units. So what is your days? Actual days. What is your units? Actual units. Okay. So maybe I'll remove this. Actual units. This is actual days. Slow and steady. Actual units, compare what is hours. For actual days, compare what is hours. Now let me go for capacity. 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 Now remember the word capacity, guys. So days with respect to your hours. This is only days. Okay, that to actual days. Now for your actual days, how much should be your budgeted hours? For example, 25 days, the hours is 30,000 hours. For 25 days, the hours is 30,000 hours. Now, please look at this. How many standard hours per day? Standard hours per day is equal to 30,000 hours divided by 25 days. That means 1,200 hours per day. Wow. Standard hours per day is 1,200 hours. Now, how many days you have worked? 26 days you have worked. So that means, what is your standard hours for this actual days? Your actual days is how much? That actual days is equal to 26 days. So for 26 days, what is your standard hours? What is your actual hours? Very simple. So, your actual hours is how much, guys? Your actual hours is 33,000 hours. Okay. So I will not, this I have to remove this. No, sorry. I thought this is your cost. That 50,000 is your cost. Got it. So our actual hours is 33,000. What is your standard hours? Very good. 26 days. For 26 days per day is how much? 1,200 hours. 31,200. So for 26 days, you must work only 31,200 because per day 1,200. But actually, how many hours you work? 33,000 hours. Capacity is more. More hours are there. That is capacity. But whether the capacity is utilized or not, you'll see in efficiency. But capacity has increased. because more days. So what is your fixed overhead per hour? Because this is hours, no? Fixed overhead per hour. Okay, fixed overhead per hour is how much? 1.5 rupees per hour. So naturally, your capacity has increased. 33,000 minus 31,200 into 1.5. So 1,800 hours you have worked more. So therefore your capacity has increased per hour. So 2,700 is your favorable. Okay, so favorable capacity. You have worked more capacity. But don't bother about the volume. Don't bother about the units. That I am going to see in efficiency. So calendar is only days. Capacity is days with respect to hours. For that day, how many hours you should work? Now, for working node 7 is the efficiency. Here, I will compare the, what do you call it as the actual units. Actual units. So how many units? Actual units and hours. So that is what it is given. Actual units for hours. Actual days for hours. Now, what is your standard hours for your actual units? What is your actual hours? And what is your fixed overhead per hour? Remember, both are hours. But here it is actual units. How much is your actual units? Your actual units is 32,500. Okay, 32,500. Wow. What is your actual hours? 33,000. What is your standard hours for 32,500 units? For 1 unit, 1.5 hours. Because standard fixed overhead per unit is, standard hours per unit is 1 hour per unit. 1 hour per unit. Standard hours per unit. 1 hour takes for 1 unit. So 32,500 units will take how many hours? 32,500 into 1. So 32,500 hours is standard hours, but actual hours is 33,000. Great. So instead of taking 32,500 hours, you have taken 33,000 hours. So 500 hours extra you have taken, which is efficient or inefficient? Inefficient. So what is per hour fixed overhead cost? Per hour fixed overhead cost is 1.5 hours. So therefore, 33,000 minus 32,500, which is adverse 500 hours. So it is 750. It is adverse. 750 adverse. So now 750 adverse. So this is 750. This is 750 adverse. 750 adverse. And this is capacity is favorable. Capacity is 2,700 favorable. Okay. Now please add all this. 2,700 plus 1,800. It is 4,500. 4,500 minus 750 is 3,750 favorable. So 5,000 adverse and 3,750 favorable. Net is 1,250 adverse. That's all. Very simple. So this is how your entire fixed overhead variance is structured. Now, please come to your examination question. November 2018, 5 marks. Very interesting. Now, what is the advantage of this particular question compared to the previous question what we did? So I'll just do this. November 2018. November 2018. So what I will do, I'll just copy this, the entire structure here. Okay. So the only thing is, don't worry about. Okay. So all this we will find out what is the answer is. Okay. So here the month, for the month you have to find what it is. So November 2018, what is the question? Manufacturing concerners provide the following information: output, days, fixed. Hours they have not given. Hours they have not given. But without giving hours, they are asking efficiency. Without giving hours, they are asking efficiency. That means directly you have to find the output. Ultimately, please look at this. What is efficiency? Actual output, actual units with respect to hours. That means with respect, instead of hours, you take days. You take days. Because in this question, they are giving only days. Units and days. Actual units is 4,800 and days. So you have to directly apply the time rather than hours. If time is not given, you apply the days itself. Because efficiency with respect to actual units 2 hours and capacities with respect to actual days 2 hours. Okay. So that is why this question is a very, very interesting question. When you apply your normal model, this may not fit to that model, but you have to apply your logic. I repeat, you have to apply your logic. So let me do this question, guys. Please pay your attention now. Okay. We have very limited time and I'm going to do this particular question. Please look at this. So what is your question now? Standard and actual. So I will not call this as standard. I have to call this as budget only. So your question is, I will only call this because anything related to fixed, that too with respect to a period, you cannot call it as standard. You have to only call it as budget. Okay, and actual. So, but with respect to material cost, with respect to labor cost, with respect to variable overhead, you can call this standard. Anything because per unit, you can always call it as standard. That is why there is a difference between budget and standard. These are all standards. This is budget. Why budget? For a period. For a period. This is for which period? Manufacturing concern as for a following info related to fixed overheads. Output in a month. Working days in a month. Fixed overhead in a month. So that means this is a per month. Details for a month. Okay. So details for a month. Moment they say for a month, it is always budget. The budget is always for a period. Okay. Please be very clear about this. Okay. So now what is given? Output. The output is how much? 5,000 and 4,800. 4,000. Good. And he has given days 25 and 23. Yes. And fixed overhead is 5 lakhs and 4 lakh 90. Fixed overhead in rupees 5 lakh and 4 lakh 90. I can tell you one thing very, very straightforward. I told you straight. What is straight? Fixed overhead expenditure is straight. Straight away. Instead of 5 lakh, you have spent 490. So therefore 10,000 favorable. Therefore 10,000 favorable. I'll only call this as what this is actually you have spent less, no? Actually is 10,000 less. So it is 10,000 favorable. Straight away you have got 1 mark. Out of 5 marks, 1 mark you have got it already. Okay. By looking at the question, you can actually put this answer. I told you this is straight. That is why in this I would have given. What is the expenditure? Straight for the month of August. Straight for the month. Straight for the period. Straight for the month. Whatever it is. It's straight. No need to actually break your head with respect to this. Straight blindly you can say, what is the monthly fixed overhead 5 lakhs? What is your actual 4 lakh 90? Wow, 10,000 saved. That's all. But fixed overhead, the total fixed overhead variance. Okay. Either fixed overhead cost variance, total fixed overhead variance, whatever name you give. Please be clear with the logic, which is on top. Total overhead variance, total fixed overhead variance, or fixed overhead cost variance. Okay. The total. How will you do it? This with respect to units. Actual units is how much? 4,800. Okay. So this is the first thing. Now I need to do the working note 1. This is working note. What is the working note 1, guys? Remember to find out all the per unit. The standard. Okay. Fixed overhead per day. What is the standard fixed overhead per unit? Okay. And what is your standard output per day? So So here, let us find out that one by one. Okay. Standard fixed overhead per day. It is 5 lakhs divided by 25 days. So per day, you spend actually 20,000. Per unit, 5 lakhs divided by 5,000. So per unit, it is 100 rupees. So this is rupees per day. It is 100 rupees per unit. And how many output per day? 5,000 output for 25 days. Then 200 units per day. Output units. Okay. So this is your standard. Now let us directly find your fixed overhead variance. Actual units. Straight away you have to find actual. So what is your actual overhead? Actual fixed overhead. What is the recovered fixed overhead for your actual unit? What is your actual units, guys? 4,800. Wow. Now, all of you please look at this. What is your actual fixed overhead? This is your actual fixed overhead. And your actual fixed overhead, 4,90,000, is what you have spent for. I repeat, you have spent this 4,90,000 for how many units? 4,800. So, for 4,800 units, per unit is how much? 100 rupees. So, for actual units 4,800, you should recover only 4,80,000. You should have actually spent 4,80,000. You should actually spend. So, fixed overhead variance for that month, okay, what do you call it as? Absorption. This is called as absorbed. Okay, absorbed fixed overhead. Recovered fixed overhead. This is actually called as absorbed. And you are going to do absorption costing. That is a chapter number 3. If I am right, in chapter number 3, you will be seeing the, chapter number 4. Chapter number 4 is absorption costing. So this is recovered fixed overhead or absorbed fixed overhead. Okay, for your actual units is this. It's called absorption. So now please look at this. Instead of 4,80,000, you have spent 4,90,000. So therefore, the difference is 10,000 adverse. Adverse. Okay. So you can call this as negative. So 10,000 guys. Okay. So 10,000 adverse. Now, one thing is very clear to all of us that if this is 10,000 adverse, this is 10,000 favorable. Volume is 20,000 favorable. Sorry, 20,000 adverse. So 20,000 adverse and 10,000 favorable, you have 10,000, what do you call it as adverse. So how do you find volume variance and expenditure variance? So let us find first the volume variance. Or expenditure variance, anyhow, all of you know this. Straight away we can do it. So I need not spend time here. All of you know. Straight for the period. So here some month, we don't know which month it is. Okay. So which month it is, we don't know. Okay. Current month. We'll call it as current month. That's all. So what is your budgeted fixed overhead? What is your actual fixed overhead? So please look at this here. I'm using the word budgeted. Budget for the current month is 5 lakhs. Actual for the current month is 4,90,000. So therefore, okay. So 10,000 favorable. Actually, it is favorable. I'll put it in green color. Why? You should spend 5 lakhs for this month. You have actually spent 490. Because fixed overhead is always for a period. Fixed overhead is very, very interesting. What do you say? A different breed. Different breed of expenses. Okay. So the same logic from a material perspective, labor perspective, it is different. Because we will not go by this logic. We will only go by unit, hours, everything. So working note 3. Now working note 4. This is fixed overhead, volume variance. Wow, volume guys, volume means what? Units. Units is what? 5,000 and 4,000. 4,800 is your actual units. Okay, so your units is actually 4,800. So volume units. Okay. So your units. So very simple. So what did I say? Your So guys, what is your fixed overhead per unit? Okay, fixed overhead per unit. So what is your actual units? What is the fixed overhead per? Fixed overhead per unit is 100 rupees per unit. What is your actual units? You have manufactured 4,800, but your budgeted units is how much? 5,000. Instead of 5,000, you have only manufactured 4,800. So therefore, 200 units you have manufactured less in the current month. So 200 into 100, it is actually okay. So 200 into 100 is how much? 20,000. So 20,000 adverse. So we have to put it in red color because 200 units less. 20,000 adverse. Good. But please look at the question. Fixed overhead variance 10,000 adverse. Expenditure variance 10,000 favorable. Volume variance 20,000 adverse. Now this volume you have to again divide into efficiency, capacity and calendar. Actually calendar variance I will do it. Okay. Eric, you can find calendar, but they have not asked calendar. I will do calendar. So what is calendar, guys? Days. Actual days. So all of you know how to find calendar. Please look at calendar. Days. Okay. So you have to find what is your budgeted days, what is your actual days, what is the fixed overhead per day. That's all. Very simple. Your budgeted days is how much? 25 days. Instead of working 25 days, you have worked only 23 days. Baapre. This is adverse, no? And per day it is 200. Per day it is 200 days. So therefore, 2 into 200. 2 days. Sorry. Per day it is 20,000. This is different. 20,000. 2 days into 20,000. 2 days you worked less. You worked more means favorable. You worked less means for same salary, if your people are working less, then it is adverse. For same salary, people are working more, then it is favorable. 2 days less. Budgeted number of working days is 25. Actual working days is 23. For school children, it is favorable. From children perspective, 25 days school, instead of that 23 days only it is working. Then the students will actually overjoy. Very good, holiday. But this is not, I am in business. That is why I say, in life you have to learn. In business you have to earn. Okay. So 2 days into those 40,000. So 25 minus 23. So what is it? 40,000. Adverse. Why adverse, guys? Adverse. That's all. 40,000. So calendar 40,000 adverse. But this is not. This is negative. Now, but the question doesn't ask calendar. They ask efficiency. All of you know what efficiency means. Efficiency is always with respect to actual units, with respect to hours. But here I am going to do. Okay, I am going to do efficiency. Don't worry, I am going to do. So this is 6 efficiency. But here actual units. What is actual units? Your actual units is how much? 4,800 units. So actual units with respect to hours, but hours is not given. Actual units with respect to days is there. Days is also time only, no? So I will take days. Very important, very important. Okay, please be careful, very important. So efficiency is always with respect to time. So here time is given. Instead of hours, they are given days. Okay, that's all. So therefore, please look at this. That is why standard output per day is 200. So in 23 days, how many output you have to do, or in 4,800 output, how many days you should take. Okay, how many days you should take. So that is where it is very important, guys. So now please look at this. Standard hours and actual hours for your actual units. Okay. Now instead of this standard hours, is standard hours is possible? No. I'll say standard days, actual days. Fixed overhead per day. Instead of fixed overhead per hour. Because time. Now, for human beings, second is very small. Days is okay. Years is very big. There was somebody who was financing Lord Ishwar. Lord Ishwar came in front of him. And somebody asked, Lord Ishwar, I want a boon, but before that you have to explain me the time difference, time value of money difference between Bhulokam and Kailasam. Bhulokam and Kailasam. And what is the time difference between Bhulokam and Kailasam? He said very simple. 1 minute in Kailasam is equal to 1000 years in Bhulokam. Ooh. Then what is the money difference between Bhulokam and Kailasam? 1 rupee in Kailasam is equal to 1000 crores in Bhulokam. Then the man asked, Lord, please give me your 1 rupee. Okay. Lord said, the Ishwar said, please wait a minute. Because 1 minute for Lord Ishwar is 1000 years for human being. So, please remember that whether it is hours or days, both are same. It's time only. So, actual days for 4,800 units, you have taken 23 days. But, how many days you will take per unit? So, this is reverse I will do. Standard day per unit. So, this is 25 divided by 5000. This is the number of days per unit. So, therefore, 4,800 will take how many days? 4,800 into 0.005. You should take 24 days. But you have taken 23 days. So, favorable. Favorable. How many? This is, favorable. So, 20,000 per day. So, 1 day you have reduced. For 4,800, you should have taken 24 days. You have taken 23 days. So, therefore, favorable into 20,000. So, it is favorable. Green color. That is a catch, guys. So, 20,000 favorable. Efficiency. 20,000 favorable. That is efficiency. Where is it? Favorable. 20,000. Now, I am sure all of you can tell me capacity. Because this is 20,000 adverse. 40,000 adverse and 20,000 favorable is 20,000, what do you call it as adverse? Naturally, capacity is 0. Capacity will be 0. Okay. For your kind information. Okay. So, that is a catch, guys, here. So, very interesting for your kind information. So, 10,000 favorable, volume. What is volume, guys? Volume is 20,000 adverse. Okay. And expenditure is 10,000 favorable. So, naturally, there is no capacity here. Okay. So, that is a part. You can even try the capacity. What is your capacity? Capacity is hours. But you cannot, since the word hours is not given, days to hours. Please look at the word. Days to hours they should give. So for 1 day, how many hours? So therefore, days to days only you can actually compare. So that is why capacity you cannot do here. Okay. That is your fixed overhead variance for all of you. So guys, I must thank each and every one of you. So I must thank each and every one of you for being part of today's morning session. And I wish each and every one of you continue your support. there are 3 things I want to share with all of you. Number 1, subscribe. Okay, subscribe, the button which is down below. Please click the subscribe button. So every day, whatever link, because tomorrow morning also we are going to have at 8:30 a.m. So I will be, what do you call it, as all of you will get the notification in your mail as well as in your mobile if you subscribe. Second, the link will be posted in the group. So therefore, if you want to be part of the WhatsApp group, okay, the WhatsApp group is called All India. Okay, the name of the group is All India CMA. Okay, the CA Inter CMA students group. For that, you have to send a request to this mobile number 98401 63269. I repeat, 98401 63269. What you must send a request? You must send your name. You must send your registration number, student. Okay, you must send your student registration number, ICI student registration number. Then you must send your location and you must send your mobile. All this you have to send to 98401 63269. The WhatsApp administrator will actually add you in that particular group, and the link also will be posted every day there so that you can also share it with your friends. Okay, so I must thank each and every one of you. Any comments you want to share, you can leave your comments in the comment box, which will be definitely taken at earnest spirit to implement it in the next few sessions also. So thank you very much, you guys, and have a great day. Every day we are only going to have a 1-hour session, and which is going to be a power-packed session, exam-oriented. So whatever that is possible within this 1 hour, I'll try to do the best. Best of luck to all of you. Thank you very much.